It's a great privilege and pleasure for me to introduce Senator Jeff Merkley. Senator Merkley has been representing the working and real families of Oregon for quite some time. He was Speaker of the State House. He's now in his second term representing them in the United States Senate. He began his career in Washington in the Congressional Budget Office and the Pentagon, looking at nuclear proliferation. So he's really been thinking about issues from a federal and state perspective for many years. Incredibly impressively, he holds a degree from Princeton University in Public Affairs from the Woodrow Wilson School, a degree with which I share with him. And it's a great privilege for me to introduce another wonderful fellow Princetonian in Senator Jeff Merkley.
Well, good morning, everyone. You all just heard from the panel of experts in their field. I guess you could say, more of a generalist, and I come to this conversation concerned about the fundamental proposition of families thriving. By the way, Aaron, as you were introducing me and you mentioned that I'd worked on strategic nuclear weapon policy way back when, I can tell you when I went back to Oregon in 1991, it was really hard to get hired to do anything. That was not a specialty that had any traction back home. I remember applying for an internship with a utility. So I thought, well, this deals with energy, maybe some connection, and I couldn't even get a reply from them. So it was a rough transition. But it's a pleasure to come and connect with you all today about this area, an area in which I encourage you to keep educating me, educating people on Capitol Hill, because we're pretty far behind the curve on the things that you're working on every day and the evolving technology, the rapidly evolving technology and strategies. There's quite a lot that can be done. I'm approaching it from the viewpoint of how you pave a highway for innovation, but the highway has safety rails, guardrails, so that you don't go off the track too often to the destruction of consumers' financial lives. But as I was pondering how rapidly things are evolving, I thought I'd do a little interview here of you all and ask how many of you have used Apple Pay? Okay, about half the room. How many of you have downloaded Venmo for person-to-person? Wow, even more. Okay, well, I have a feeling if you were to interview senators, you might get just a couple who might be raising their hands in that situation. A few years ago, I held a hearing on Bitcoins and what the challenges that represented for the international marketplace, international transactions, money laundering, security, and it was fascinating to wrestle with something that we were totally unfamiliar with and the implications it might have for the system. Since then, many other types of virtual currencies have emerged. It seems like about every 2 or 3 months you hear about a new strategy with new potential implications, and that's just one little tiny piece of the puzzle. We have products like blockchain, online system used by companies to track transactions and ledgers. And certainly an area where a number of fintech firms are focused is developing a way to process financial transactions in real time. It seems an anachronism that here in 2017, when you deposit a check, it might not actually be credited to your account for more than a week. That's a relic of an old system, and all kinds of financial strategies are working to improve that time or bypass that time. And an area I've been particularly interested in is marketplace lending and the guardrails that exist there. And I suppose this grows a little bit out of the background I have in Oregon. When I went back and couldn't find a job in strategic nuclear policy, I went to work running a nonprofit, a Habitat for Humanity affiliate. And every time we completed a house, it felt like a miracle. A home was completed, you had a celebration, you handed over keys, a family that had been living in a basement, a family that had been living in a van, a family that had moved 8 times in the previous 15 months, they'd been couch surfing, they suddenly had a place of their own. and it transformed how that family interacted with the community. The children did far better in school, and they were in the same school year after year instead of moving and moving and moving. They had pride of ownership, and it affected their sense of self-worth and the ability just to invite friends over. It transformed their lives. And while we were launching this Habitat affiliate, we were trying to accelerate the pace at which we could enable families to buy homes and go from building one a year to building one every 3 months, and eventually several dozen per year. The affiliate kept growing, more affiliates opened up. And then a few years later, and I think it was about 2009, 2010, I'm back here in the Senate, and I was asked to go to a celebration of the 1,000th house that had been built and sold by Habitat, empowering a family. And that was great, 1,000 houses when we were about 10 houses when I became director of Portland Habitat for Humanity. But then if you looked at how many families had lost their homes due to the financial strategies, the financial policies, due to our regulatory system and the legal structure passed here in Washington, D.C., you were looking at tens and tens of thousands of folks across Oregon where the homeownership system had failed. So policy makes such a profound impact. And it isn't just in that particular area, it's in the whole variety of areas where predatory practices can undermine the success of a family. So I'm coming at it from the viewpoint saying a system that helps families succeed financially is a system that we should strive for in America. More stable families, more successful children becoming more successful adults. And that is powerful. Meanwhile, if we turn back now, so that's a sense of where I'm coming from on this. If we go back and think about how lending is growing in the fintech area and how much they are speeding up the process of getting loans approved. Having gone through traditional loan processes a number of times, it takes several months. The idea that you can go and get a loan in a 48 or 72-hour period sounds pretty appealing and serving a useful place. And that area, the online marketplace platforms, is growing very, very quickly, originating over $5 billion of unsecured consumer credit in 2014. The next year in 2015, doubling to $10 billion, continuing to go up. Lending that is enabling families to consolidate existing debt, pay off credit cards, finance improvements to their homes. And we would like to see the innovation continue that creates positive factors in the marketplace. And that's the paving of the highway for innovation. Now, one area where I worked hard to pave the highway was in equity crowdfunding. I thought, we have all this peer-to-peer lending emerging, and we have all of these sites like Kickstarter where you can donate funds to charge up some nonprofit effort, or perhaps even donate your funds to a for-profit effort, and maybe they'll send you their first product, a copy of their first product. But we didn't have equity crowdfunding. So I worked to write that bill, and I also wanted to acknowledge Congressman McHenry, who you heard from earlier, who worked a lot on that particular issue, and I think he may have shared some of that with you previously. But I thought equity crowdfunding could be a powerful complement in the financial marketplace, enabling small companies to bypass venture capitalists, angel investors, traditional lending in ways that might actually be very, very effective in assisting folks in gaining access to funds. And particularly as we were working on this issue back in 2009, when traditional lending had often crashed, I couldn't go to a town hall without someone standing up and saying that the availability of credit is really destroying my ability to seize opportunities in the marketplace. Well, it took quite a while for us to line up the bipartisanship and get that bill passed, but it eventually happened. The implementation of it was slow. The SEC was extremely slow in writing the rules. But in this equity crowdfunding bill, you can see the highway being paved and you can see the guardrails. The highways being paved in a fashion that we didn't know how the websites, the crowdfunding sites would evolve. Would you see sites that specialized in folks who want to invest in restaurants? Would you see sites sponsored by local chambers of commerce to get people to invest in the companies in their particular community, strengthen their community? Would you see sites that specialized in doing far more vetting than was required under the law to give additional confidence to investors? Would you see that there would become a single dominant player, kind of the eBay of equity crowdfunding, because of the power of many different options being located in a single place? How would this evolve? We didn't know, and we're all paying attention to see exactly how it will evolve. But meanwhile, we worked to put sideboards on how much an individual could put up in different companies, and sideboards on how much information had to be, or guardrails on how much information had to be provided at different levels of equity that you're seeking, so it was proportional. So you had increasing transparency as the transactions got larger, and you had, as long as it was honored, which was a piece we wrestled with, a framework in which people could invest, but they wouldn't lose their entire retirement savings and become kind of a tragedy, financial tragedy that would be a disincentive for others to participate in this marketplace. In other words, that would hurt this marketplace from the very beginning. I was struck that just a small percentage of the savings that Americans have, if put into crowdfunding investments, would exceed all the angel and venture capital being combined and being invested in America. So one of the downsides that's emerging in the fintech lending space is that while providing opportunities for small businesses and speed, the loans often are carrying significantly higher interest rates. According to a May 2016 report from the Opportunity Fund, annual percentage rates for these alternative loans average around 94% and can reach as high as 358%. Well, that's a pretty high interest rate. And I don't know how many of you would take a credit card that had that interest rate on it. And you'd be pretty leery of taking a loan of any nature that had that type of interest rate. The character, therefore, starts to look a little bit like the payday loan sector. Now, as I was working with low-income families at Habitat for Humanity, we had intensive counseling over lending and interest rates and layaways and other financial challenges and tricks and traps in the system. Because for people to be successful as homeowners, the more financial information, understanding they had, the more likely that they were going to succeed. And often they had been set back, families had been set back by one mistake or another, and very high interest, short-term lending was a substantial factor. Earlier in Oregon's financial history, it had decided that during the very high interest rates that were predominant during, well, and by very high now I'm talking about mortgages that were 11, 12, 13, 14% back in the mid-'80s. That's where the interest rates were when I bought my first house. There was a sense that the previous usury caps that Oregon had, the interest rates were bumping up against them, and the space was so small that credit was becoming constrained. And so the solution would be to take off these caps. And that the competition in the marketplace would keep the interest rates within a reasonable range. But after the caps were taken off, and this happened in state after state after state, not simply Oregon, the marketplace didn't prove effective in creating a competitive environment that kept those rates low. And so we had in our payday loan interest in space interest rates that range from about 350 to about 500%. And you could go to a street corner in my blue-collar community, a community I still live in, a community I went from third grade to high school in, the community where my children went to the same public high school that I went to. You could go to a street corner and you could see 3 payday loan shops. The profit margins were so enormous, storefronts were just opening all over the place. And much of the community that was depending on payday loans was the unbanked community, intimidated by the complexity of our banking system. And at that moment when they were short, the easy place to go was that payday loan operation. Now, nationally, we'd had the military come to Congress and say, these high interest rates are destroying the finances of our military families. And we cannot have such destruction of our families that we are relying on for national security. And so Congress said, you're right, we shouldn't allow these practices around our military families because it's destructive to them. So they passed an interest rate cap of about 36% for military families and areas around military bases. And the question I pondered from that was, if we're going to help our military families succeed by not being subject to payday lending 300%, 500% interest rates, why don't we have that same protection for every family? We used to have it. Many religions in the world for centuries have talked about the challenges of high interest rates and the destructive power that they can have. Why not give American families, all American families, the same protection that we have for our military families? And I led the effort from the time I was first elected in the state legislature in 1999 through when I became speaker in 1987 to put a cap on those interest rates. And what I discovered is when you're in the minority and you're not in the leadership, it's harder to get things done than when you're in leadership. So I worked on this each year and then became speaker in 2007. And lo and behold, we passed a payday lending interest rate cap. And the industry said, oh, this will be terrible. You'll take away options from families. Payday lending will disappear. In other words, short-term lending that people need to be able to pay their rent. They're going to suffer other charges and embarrassments. But we knew from other states that that wasn't the case, that you would still have outlets for payday lending. We covered payday lending, title loans, consumer loans, kind of the whole framework. And the result was as we expected. We have about a third to a fourth the storefronts, but our citizens can go and get loans at 36% rather than at 500%. And the families are far more successful, more able to pay those off. I think this was capsulized when I went to a food bank, and this was about a year after we had put this interest rate cap in place. And the head of the food bank came out to greet me and said, Senator, the first thing I want to tell you is we saw a dramatic change in the families coming to our food bank, because we used to have a stream of families who'd been destroyed by those 300 and 500% interest loans, and now they're not, and thank you. And then she said, but the financial crash and the loss of jobs has done even more damage, so we have even more people coming, so you need to do even more to help and support our food bank. And indeed, that crash, the 2008 crash, hit people very, very hard. But that's the challenge then. And how do we pave the pathway, like with equity crowdfunding, and encourage innovation, but also make sure that we don't destroy families, that we strengthen families. And certainly I've seen the power of home ownership. Home ownership was the biggest wealth builder in middle-class American families until 2008. And then the American dream of ownership became the American nightmare. And why did that happen? Well, we forgot to put up guardrails. We allowed liar loans. We allowed steering payments that were kickbacks to loan originators. We proceeded to allow teaser rate loans. So a person, a middleman promoting a mortgage could say, trust me, my job is to get you the best possible mortgage, take this one, and the homeowner, unfamiliar with the complexities of the mortgage market, didn't know that that individual was getting a fee that varied according to which loan you steered them into, and steering you into a bad loan gave them a higher fee than steering you into a good loan. So I tried in 2008 to pass a law in Oregon that restricted the teaser rate loans and the liar loans, the underwriting, and we passed it in the Oregon House. Then it went to the Oregon Senate, and the Oregon Senate said, no, we're not going to touch this because it's unfair. And they argued, and they had a fair point, it was unfair between state-regulated enterprises and federally regulated enterprises, and that it would be a disadvantage to state enterprises. So I thought, well, we should do it at the federal level. And when I was elected to the Senate, I was speaking to my caucus about this, and Senator Dodd slipped into the seat behind me and said, we need you on the banking committee. And I said, well, I had my two major committees already assigned, but perhaps there'd be possibility of a third. Perhaps I could trade in the budget committee for the banking committee. He said, I don't think Harry Reid will go for that. And Harry Reid calls me up. I'm down in that basement location where there are so many new senators. 5 of us were sharing a little tiny space under Dirksen Senate Office Building. And Harry Reid calls me up and says, we need you on banking. I said, great. He asked me which committee I'd give up, and I said, well, I can't give up my 2 major committees, but I'd be happy to get rid of the budget committee, trade that in. And he said, nobody gets off the budget committee, and hung up. And he called me back a week later, and he said, you're on the banking committee. I said, well, which of my major committees did I lose? He said, no, I can't take those away from you under the rules. I said, oh, then I've been able to trade in the budget committee for the banking committees. He said, no one ever gets off the budget committee, and he hung up again. And so I continued to labor on the budget committee. But what we did in Dodd-Frank was to put an end to those liar loans. What we did is said no to the teaser rates. What we did was create a Consumer Financial Protection Bureau that could take on predatory practices as they emerged. We'd had a credit card bill earlier, and it addressed certain specific actions of a predatory nature, but those evolve in the marketplace. You can't have, if you will, if you can think of consumer products, a division of the government that says every time there's a new product in the market, we have to pass a new law affecting whether or not there's lead in it or some other toxin. You have to have an organization saying, oh, there's a new product, is it safe? And that's what the CFPB does for financial products. And we're going to be facing an intense conversation over this. And I'm sure there's a host of conflicting or various viewpoints on this here in the room, from folks who feel that you've gone too far. The guardrails are starting to not just prevent people from running off the road, but perhaps people from driving down the road. And that's the conversation that we're all going to be having as we go ahead. And in the middle of this is this question over the OCC charter and the issues that are being raised by that possibility. And I do think it's going to be a robust discussion, a good discussion, and that there's going to be an open effort to figure out whether it makes sense, and if so, how it is designed. And one of the issues here is, do we create an issue of our concern about regulatory arbitrage? And how might that play out, and how might we address that? Do we create a concern about the overruling of state consumer protections in the course of establishing this national charter? And these concerns have led to, and by the way, in terms of state protection, that includes the interest rate concerns. These concerns are shared by 50 state banking regulators, including DC and, well, or adding on DC and Puerto Rico. More than 250 organizations have raised similar concerns. The Independent Community Bankers, the Consumer Bankers Association, Americans for Financial Reform, Center for Responsible Lending, National Consumer Law Center, and then you can envision the balance of the organizations, some of which are national and some of which are state-based. So that is why it makes it relevant, the discussion you're having, the panel you had with these experts. And I think the role that you all can play with those of us on Capitol Hill is bring your insights to our staff members, to our team. Invite us to jump into those meetings and hear them firsthand, to understand the huge range of products we're talking about and the subtleties of a potential charter and how it might interact with other charters or interact with state regulations. So I simply pledge to be an engaged part of that conversation, and thank you for inviting me to share a few thoughts with you today.
Since we're short on time, we'll jump right into this. I just want to, as an alumnus of the Senate Banking Committee staff, thank the Senator for answering the question once and for all, which committee would you rather be on? Thanking our budget. We're running late on time, so I'm just going to ask one question and turn to the audience. Senator, I asked this of other folks. What are the three things the federal government can do, or the state government, policymakers, to promote the good and protect the bad from fintech?
Well, one of the factors that I would encourage people to look at is the SAFE Act, an act I've introduced twice. I'll be introducing it again. It tries to take on a problem that is related to the concern about the fintech charter, and that is the challenge of online entities bypassing state rules on payday lending. The ability to do remotely generated checks has enabled folks to go to entities that might be based overseas. Who knows? They might be based in somebody's garage somewhere, but they're bypassing the state regulations. And even though in Oregon they would be illegal transactions, once your bank number is in the hands of an entity, they can reach in and grab your funds and be gone before you know it. So it makes addressing this balance, the yin and yang of the innovation highway and the guardrails, extremely difficult. A second issue is certainly for us to continue looking at how checks are processed and the time lag, and there's many fintech organizations stepping into this particular space. And if we don't change the traditional banking system, I think we'll see the average consumer starting to move in other directions. And particularly, this is important to working Americans who, when they deposit a check, and now if you do it through a Snap check type, take a photo of your check and deposit it, and you get a message and the message instantly says your check has been deposited. And then you think the funds are in your account. And so you spend against it, and then you find out that you've racked up a whole set of fees. So that's a second. And a third is I think we need to back up the CFPB in terms of their work on the prepaid credit cards. This is a classic case where there's hidden fees. There is the challenge then of overdrafts that emerge from that. And while the rule is not implemented yet on payday lending, not completed yet, I do think we need to try to find a national framework for that. It would be much simpler to simply have a law like many states have that creates a national interest cap. But in Dodd-Frank, one of the compromises that occurred was that it was specifically disallowed to put a national interest rate cap on it. And I remember Senator Durbin trying to lead the effort on the floor to establish that was unsuccessful. And so we're caught in a land where there's really a complicated strategy the CFPB is putting together involving rollovers and a number of other things. And if anybody who isn't dealing with it every day can remember all the details, then you have a photographic memory, and I applaud you. But for everyone else, it's kind of a tangled web. So that could use a lot of work.
Yeah, protecting the prepaid card rule is very important, and real-time payments would make a huge difference for working families. Time for one question in the audience. Who has the best question?
Thank you. Justin Lee from George Mason University. So we touched upon a lot of keywords about fintech, like financial inclusion or leveling the playing field. One thing that we didn't talk much about is the power of wisdom of the crowd, which has been mentioned a lot, at least in the context of equity crowdfunding. So I'm just interested in the context of promoting the good for the government, how can the regulation to better harness the wisdom of the crowd in the context of equity crowdfunding, also whether you see that this notion has any bite in other fintech areas outside of equity crowdfunding. Thanks.
Well, thank you. When we were working on the equity crowdfunding, we were looking at what was developing in the online lending, person-to-person space, the very different models that were evolving, that different companies were experimenting with. We were looking at the donation space, the Kickstarter space, if you will. And nobody really knew how those spaces would evolve, and we knew that we wouldn't understand how equity crowdfunding would evolve until we put in place a way to do it and then watched what would happen, and that we might need to respond to that in a periodic basis. A year, 2 years into it, monitoring, do we have the right guardrails, or do we have guardrails that are obstructing legitimate, valuable flow of innovation, of traffic? And on the other hand, there are other ways to pave a wider path that still will work. We just didn't know how it was going to unfold. So I think our concept was, and we put in a quick response strategy for potential predatory operations into the bill, but we couldn't put in a quick response for, if you will, rethinking and broadening, reconstructing the highway. But the conversation was that this is going to have to be continually monitored in these other early years to make this model work, assuming we wouldn't get it perfect the first time round. And when we speak of the wisdom of the crowd, as you just did, watching how the crowd operated would be critical to understanding how the highway can be built better. In other areas, I would defer to the experts. It's just fascinating to watch how many new ideas are being adopted quickly. It was about a year and a half ago I read a report that said young folks are gravitating away from Facebook. Oh my God, this is the end of Facebook. They're going to go to X, Y, and Z. Well, here we are a year and a half later. Facebook is thriving. Watching how consumers interact with these new products, continuously new opportunities. I was pondering when I was at the White House probably about a year ago, and Senator Cory Booker said, Jeff, let's do a what do they call it? Video snap?
Video snap? Snapchat?
Snapchat, right? And I didn't even know what the hell it was. And how quickly that's changing. And now I hear colleagues saying, we have to learn to do what Cory Booker learns to do. Where is the crowd moving in a whole series of ways? I guess it's just a very exciting time in the world where technology is unfolding so fast. People will find new niches, more convenient ways to do things. And it would be interesting to take people's best guesses right now and then have this gathering a year from now and see which things are starting to materialize, which aren't, or 5 years from now. But the answer is I don't know, but it'll be fascinating to watch, and we're going to have to adjust to the wisdom of the crowd.
Great.
Thank you all.
Thank you very much, gentlemen.